So there's plenty of blame to go around. There's blame at the bank board and management level. Recall there's been agency guidance from the Federal Reserve, the FDIC, OCC, the Treasury. There's been guidance over the especially last few months, but recently in the last couple of years around serving the tech community, serving startups, serving especially the cryptocurrency ecosystem. Not saying flat out that you can't do it or you shouldn't do it, but identifying that there are substantial risks here, and those risks need to be accounted for. But there's also blame to go around towards some of the examinations and the regulation teams, right? The regulatory teams. Some of the regional exam teams may have identified issues and risks, but the question is, could they or should they have pushed a little bit more to get those risks resolved sooner? There's also some question in the media about whether the lead agency heads in DC were giving enough support to the regional exam teams or identifying the same kind of risks so that there was enough coordination. Again, social media played a significant role in a lot of this as well, especially in the Silicon Valley Bank run. What we saw there was that as soon as investor community, the venture capital community, as soon as they saw that something was going on, they sought, from what I can tell, social media to say, okay, we're going to reach out to our folks, to friends, and we're just going to use social media to identify that there's an issue here. And what happened there is that it got out of control. So what was the resolution? Over the weekend, essentially for Silicon Valley and Signature Bank, the resolution was that the FDIC, the Federal Reserve, and the Treasury Department stepped in, and they used the FDIC's systemic risk exception authority. And that really backstopped all of the deposits, both insured and uninsured deposits at Silicon Valley and Signature Bank. And they did that Sunday night so that by the time Monday morning came around, when they were already planning to make available at least the $250,000 of insured deposits, what happened is they made available all of the deposits. Okay, they did that to avoid any further panic or further contagion because they used this systemic risk exception. So what's next? Well, next, we've seen all week, there's increased pressure on regional banks. I can't name all of them, but a number of them have been increased pressure from the markets. There's questions about systemic risk. Systemic risk, this idea for systemic risk more generally, we saw in 2008, 2009, and we saw with the Dodd-Frank Act. And that was really focused around institutions that were trillions of dollars in assets. The institutions that we all think about that many folks have fled to since the demise of Silvergate's SVB and Signature Bank. And so there's also questions about whether the systemic risk has to be readdressed either through legislation, regulation, or otherwise. There's additional questions about deposit insurance. So should we raise the cap on deposit insurance? I don't know what the answer is there. I don't know if there's a magic number. I'm guessing that there isn't. But the question still remains how that really should function. And now, finally, we're going to learn a lot more in the next week. We're going to learn a lot more in the next month. But next week, we've got a House Financial Services Committee hearing in Congress where they're bringing in heads from the FDIC, the Federal Reserve, and the Treasury Department. Okay, they're bringing in officials from those departments to learn more about what happened play by play, where things went wrong, why we didn't catch this, why we didn't see this sooner. And they're going to play the blame game a little bit, but hopefully out of that, we get a lot more facts and we get a lot more information that will help as we assess risks and contagion possibilities going forward. Thanks very much for joining me. Hope to see you next time.